So hello everyone, this is Mayank and today we are going to revise the entire chapter of International Financial Management. In this we are going to cover around 19 theory questions and 7 practical questions. So let's start without wasting our time with the first theory question. Discuss the complexities involved in international capital budgeting. So the very first part is we are going to find out the complexities, the problems that an organization face whenever they have to decide that whether to accept a foreign project or not. Okay, and the foreign project can be an investment from India to another country or from another country to an India. Okay, so there are 10 points that you need to remember if the question is asked in exam. The very first point is you have to convert the money from one currency to another currency. That is the biggest problem. Okay, that's the first point. The second point is there are two types of cash flows. Parent cash flows are different and project cash flows are different. We are going to discuss this in the next question. The third one was subject to tax in both the countries. Whenever you think of the foreign project, then two countries are involved and both the countries demand tax on the earnings of that project. So you will have to pay the tax in the host country as well as home country. The fourth point, if you can see here, is that there will be an effect of exchange rate, foreign exchange rate changes. So there can be some gain or loss due to changes in exchange rate on the cash flows that you transfer from one country to another country. Okay, whenever you are going to transfer, there will be an applicable exchange rate on that date and nobody knows today that what will be that rate. So this is again another risk that we have to deal with. We have to deal with the taxes also, we have to deal with the different cash flows, we have to deal with converting the currencies. Then comes the inflation. Inflation in our country and inflation in their country will be different. Okay, and because of that the competitive environment will keep on changing. The sixth point was restrictions imposed on the cash flows. That one country, that host country, suppose we have invested in America and America is putting up restrictions that you cannot transfer 100% of the profits to India. So you can transfer only 50% of the profits to India this year and the balance 50% next year. Or let's say balance 50% has to be invested compulsorily in US only. So such type of restrictions are placed by the host countries and we have to deal with such type of situation also, that whether it is feasible for us to accept the project in this case, because certain amount of money you will never bring it back to your own country. So what's the purpose of investing? One might think like that. The seventh point was initial investment in the host country will benefit. See, host country will get benefit because of the release of blocked fund. I said that 50% has to be reinvested in that country itself. It was covered in point number 6. So because of that the host country gets benefited. So that's the positive point. The next is 8, political risk. Obviously we are in India, we know more about BJP, Congress and AAP and everything. Okay, so we can predict a couple of things that is going to happen in the coming time. Let's say 5 years, 3 years. But we don't have any idea about what is going on in USA or what is going on in UK, Brazil, Canada. So if we are starting a project there always arises a risk called as a political risk. What if the government changes? What if the new government doesn't like our project? What if the new government frames some policies which are against the foreign projects? So in that case our cash flows will get affected. It will affect our cash flows. Expected cash flows will get reduced. So we have to consider this risk also, that this might happen in the coming time, that the cash flows will be lesser than what we are estimating. And in that scenario, are we ready to accept the project? Then the ninth point is concessions or benefits. It's not only the risk, there are some positive points about few countries. Those few countries, in order to attract foreign investment, they provide some kind of concessions and benefits also. So a lot of countries go lot of countries goes there and invest. A lot of companies goes there and invest in that country, who provides a lot of concessions and benefits to those companies. Okay, so that is for the purpose of attracting the investment. And the last one is estimation of the terminal value. Whenever you will decide to terminate the project, to close the project, to shut down the project or sell it to someone else, then at the time deciding the terminal value at the end of the period will be difficult for you, because that is situated in different country and the situation and the environment of that country at that time depends. So that's the 10th point of estimation of terminal value. These are the 10 points that you need to remember. The next question was discuss the project cash flows vis-a-vis parent cash flows. If you remember something that I have told you here, just a second. Yeah, so we can decide the project. We can decide whether to accept the project or not based on two different things. We can analyze the project from the project's own cash flows angle, which will include, let's say if we start a project in UK, which will include cash inflows in GBP, because we are starting in UK, cash outflows will also be in GBP, then net cash flows in GBP, then discount rate of GBP, then NPV. We will arrive at NPV, and if the project, if the NPV is positive, we will accept the project. If it is negative, we will reject the project. Everything has been done in GBP, so foreign currency itself, means we have taken a decision based on the cash flows of the project itself. But there is another point which is called as parent cash flows. Parent cash flows means whatever the project is going to transfer back to the parent, because parent is the one who decided to start that project, invested in that project. So that project's responsibility is there. At the end of the year, they should transfer the operational cash flows. They should transfer the operating cash flows and the financial cash flows. Operating cash flows means the profits that they have earned after taxes every year should be transferable. One thing. The second thing is dividend should be payable on equity, interest will be paid on debt, because equity and debt has been invested in that project. So this is called as a financial cash flow. So we can take a decision, we can calculate net present value based on these two cash flows, operating cash flows and the financial cash flows. And if the NPV is positive, then we can accept the project. So there are two different approaches to evaluate the same project. We have done this in the coming question, I will tell you. There is one question in which we have first decided up from the project's cash flows angle, and then it was negative NPV. I think that was Chinese yuan, question number 7. It was negative NPV. We said that we should not accept the project. But when we decided from the parent's cash flows angle, then we got to know that the NPV is positive and we can accept the project. So yes, it can happen that you take a different decision based on the different approach. So that is all about project cash flows and parent cash flows. Let's talk about what is given in the syllabus. From the angle of the own cash flows, means project's cash flows, evaluation of the project. So whenever you start a project in some country, the very first point is in order to decide whether to start that project, that company or that subsidiary, that organization, that entity, anything should be able to compete with the local competitors, local organizations in the same business. Okay, because it will happen everywhere that any country will prefer to give benefits to the local business rather than foreign business. So you have to decide this, whether your new unit or organization or subsidiary is going to compete with the local partners, local competitors. Second thing, if you think that setting up a new subsidiary will not be able to help us to compete with the local parties, then there is another option called as investing in the local parties itself. So why to start your own company with your own brand? Pick up one company from that country itself and invest in the equity of that company. This is something which has been done by Alibaba's Jack Ma. He invested in India's Paytm. So he didn't start Alibaba.com or Alibaba.in like Amazon in India. He started with investing in Paytm. So this is covered in the second point. The first point is, the example for first point is Amazon.in. Amazon started with did all the research and then started with its own brand in India. So they set up a project. They discussed that we will have to earn a higher return than the local competitors. Okay, the second one was the example of Alibaba, Jack Ma and Paytm, I can say. Sometimes what happens is it's not about the competing with local competitors, or it's not about the investment. Sometimes you set up a subsidiary in another country just because they should manufacture some goods which will help you to procure those goods. So basically speaking, that subsidiary is set up for my own company in India. Earlier my company was used to import the raw material from Germany, let's say for example, from any other party. But In order to save the cost, in order to give the preference, what I am doing is I am setting up my own subsidiary in Germany to prepare the raw material for my home country, for my parent country in India. So that company is not set up, that foreign project is not accepted because they have to compete with the local competitors. No, there was no such intention. That company was set up just for the purpose of manufacturing the raw material for my parent company and transferring it to my parent company, so that my operation doesn't stop anywhere. The last one is, if you decide based on the project's own cash flows, there is one thing that is good, that you don't have to convert any currency from another currency. See, in that part also, every decision was every step was taken in terms of GBP, and the decision was also taken. There was no need for the exchange rate. Okay, so that's a good part when you talk about project cash flows or own cash flows. The next comes the parent's firm's angle. So it is all about the operating cash flows and financial cash flows that I talked about. Okay, let's move on to question number 3. Question number 3 talks about discussing the adjusting the discount rate for riskier project or foreign project. So this is not a question which should be asked in exam, so I will just give you a brief about it. If your cost of capital in India for your company is 12%, so you are discounting the cash flows with 12%, right? Can you start a project in America and use this 12% rate to discount the cash flows of American company? No, you cannot use the home country discount rate for a foreign project. Why? Because the risk is different. There are lots of risk involved in that case. So if that foreign project is riskier than your company, then increase the discount rate from 12 to, let's say, 15. If your foreign project is less riskier, then you can decrease the discount rate, let's say from 12 to 10. So basically we need to adjust the discounting rate according to the risk of the project. We have done this in some practical question. I will refer this theory question and that practical question whenever we will discuss. So this is all about adjusting the discount rate and the cash flows. Sometimes it's not good just to adjust the discount rate. It will be better if you adjust the cash flows also according to the risk, but as such there is no question given in our syllabus on that part. Okay, let's leave it. Question number 3, that is now question number 4. Question number 4 is all about adjusted net present value concept. First of all, let's talk about the formula. The formula says that adjusted net present value is net present value that is called as base case NPV plus present value of tax shield on interest, means whatever tax you are saving on interest, that will be taken here, plus present value of interest subsidies if you are receiving any kind of subsidies on interest. So that becomes APV. Now why this is used? First of all, the basic assumption is, I will show you. Yeah, let's say this is a company which is financed 100% by equity. Okay, 100% by equity. Let's calculate this company's project's NPV. So you will take cash inflows, then you will take cash outflows, then you will arrive at net cash flows, then you will use a discount rate. And let's say, for example, NPV is negative. What will happen? You will reject the project. Just because NPV is negative. But it might happen that just by changing the capital structure, instead of raising 100 crores of equity, why don't you raise 50 crores of equity and 50 crores of debt and then calculate NPV? What will be the difference in that case? See, take the base case NPV. NPV means that NPV which was there based on equity capital only. So debt part is not included in that. But when you bring the debt into the company, there are some benefits of bringing that debt into the company. What are the benefits? Have a look. Benefits of tax saving on interest. If there is any kind of subsidy, benefit of that. So take the present value of those tax saving on interest and all other benefits and then find out the NPV, that will be called as adjusted net present value or APV. And suppose that comes to positive, that means what? It was not the fault of the project that NPV was coming negative. It was the fault of the capital structure. So sometimes a negative NPV can be converted into a positive NPV if you change the capital structure, if you take the benefits of tax saving on interest on debts. Okay, and your decision will change here because the NPV is positive, so accept the project. So it's better always not to reject an opportunity. So this is losing an opportunity if you are taking this decision, and taking this decision is wise, right? So this is called as adjusted present value. No such questions is there in your syllabus, so you can skip it. Yeah. Then comes, what are the different scenarios involved in evaluating international investment? So very basic situation is investing from India to America, or let's say any other country. You have raised the funds in India only, you have a lot of money, and now you want to invest that money in some different country. That's the basic situation. Apart from that, there are 3 different situations that are given, that is given in our syllabus. So what is that situation? First situation, foreign project situation. I will discuss this this type of practical questions in the coming time. One thing that can happen is the foreign companies coming to India and investing in India. A foreign company is coming to India and investing in India. That is one situation. Another situation can be an Indian company is going to America and raising the funds in America itself and investing there. So investment is done in America, okay, and funds are also raised in America. So basically Indian company going to some foreign country, raising the funds in that country itself and investing in that country, starting the project in that country. Another thing that can happen is Indian companies going to some foreign country, let's say US, and for the purpose of starting a project, that is investment. But the funds are raised through a different country, let's say UK. So this can be another situation. And we have seen such type of questions when we discussed about GDR. You remember? We wanted to invest, I think, in China, and for that purpose we were raising the funds from Mauritius through GDR. So that is also happen. That is also can happen. So I will refer this question at the time of practical part. Then comes the sources of international finance. This entire chapter is divided into 3 parts. International capital budgeting, I will show you. See, international capital budgeting, then comes international sources of finance, and the last one will be international working capital management. We have completed the first part, that is called as international capital budgeting. Now there are 4 sources of international finance. International sources of finance. Let me go to the book. The very first one out of that is foreign currency convertible bond. Then comes American depository receipt, and then comes global depository receipt. And the fourth one is euro convertible bond. I don't understand why they have given euro convertible bond, because euro convertible bond is a part of the FCCB itself. Foreign currency covers every currency, and it also covers euro. So that's euro convertible bond. Simple. Let's talk about foreign currency convertible bond now. Foreign currency convertible bond is very similar to the convertible bond that you have learned in the security valuation chapter. It was the last topic in security valuation. What are the basic features of convertible bond? We can convert the bonds into equity shares after some times. So that is one thing. Okay. What is the difference between a normal convertible bond and FCCB? The very basic difference is these type of convertible bonds are issued in a foreign currency, not in rupees, in a foreign currency. So this is a type of a convertible bond issued in a currency which is different than the issuer's domestic currency. Issued in a currency which is different. First point. Then the second point is, in other words, both the points are same. The money being raised by the issuing company is in the form of foreign currency. We are not raising Indian rupees, we are raising foreign currency, dollar, euro, pound, anything. That's the basic feature of convertible bond. Next, this is a convertible bond which is a mix between debt and equity. That's the common thing. It acts like a bond by making a regular coupon and principal payment, and then it also gives an option to get converted into equity. So these two are the features of normal convertible bond as well. Now let's talk about what are the benefits, or we say advantages and disadvantages of FCCB. If the question comes in exam, you will have to write at least 2 advantages and 2 disadvantages. So the very first advantage is flexibility to convert the bond into equity. Why to purchase FCCB? FCCB, foreign currency convertible bond. The advantage is, if we purchase this bond, we get the benefit that we can convert this bond into equity stock if we want, and if we don't want, we can get it redeemed. So both the options are available. So that's the basic part, basic benefit, flexibility of converting from bond to equity. The next benefit is delayed dilution. This is for the company. Let's say for the company wants to raise the funds, and they have 2 options. Either they can raise FCCB funds through foreign currency convertible bond, or directly issue equity. What is the loss in directly issuing equity is that your ownership gets diluted at this point itself. So for the next 5 years, let's say, because it is a startup or something like that, if you want to take a decision, you will have to take the approval from equity shareholder as well. And that will make the process complex, because you will not be the sole authority to take the decisions. So that is called as dilution of ownership. That happens in equity. But in case of FCCB, the dilution happens. There is a delay in dilution. So once you issue FCCB in the beginning, let's say for 5 years, the owners are bond holders only. They are not the equity holder of the company. So you are free to take any kind of a decision regarding the money for the first 5 years, and they will have no say in your decision. So you don't have to take the permission from anything or approval from anyone if you issue FCCB, because the dilution happens at the end of 5th year. You can see here you have given them an option to convert from bond to equity. So from this point your ownership will get diluted, but the benefit is that maybe till this point you will set up your company and you may not require a lot of permission for big decisions till by that time. So that's a good thing, delayed dilution. The third part is it is easily marketable. So if you are thinking as a company that whether I will be able to sell FCCB in the market or not, because selling equity share is easy, but selling FCCB I don't have any idea about. So what I want to say is, this is the advantage, that FCCB is demanded by a lot of investors, because for investors, if they purchase FCCB, they get fixed amount of income for the first 5 years, because they are the bond holder here, and they get interest, fixed interest for the first 5 years, let's say. And after that, they get the option of getting it converted into equity, or they have the option to get it redeemed. They can take the money back also. So it gives flexibility, and that's why it is the preferred choice of equity shareholders. And that's why there will be high demand of FCCB, and it will be very easy to market or sell FCCB in the market. So you don't worry about the marketability, whether you will be able to sell or not. It is easily marketable. Then comes disadvantages of FCCBs. The very first disadvantage is the exchange risk. See, in the entire chapter, every instrument has this disadvantage that exchange risk is there, because foreign currency is involved. The second disadvantage is you are bringing more debt into the company. See, bringing more debt into the company means at the time of liquidation, the first preference for the balance amount available with you, cash available with you, will be given to the debt holders only. So equity holders are at risk when there is a debt in the company. So that's the basic disadvantage. Skip about the third point. Then comes American depository receipt and global depository receipt, advantages and disadvantages of both. Have a look. What is American depository receipt? I will explain the concept. It's very simple. See, let's say there is an Indian company, and Indian company wants to raise funds in America, USA specifically. So what Indian company will do is, Indian company will sell 10 crore shares, equity shares, okay, and that will be deposited with the custodian bank. Okay, that will be deposited with the custodian bank. It can be a custodian bank in India as well, not necessarily USA. Okay, so it will be deposited with the custodian bank. So suppose it is being deposited in a custodian bank in India, then this bank will enter into an agreement with the custodian bank that we have received the equity share and we can now raise. So what will happen? 10 crore shares are there with this bank of the company, and those shares will be bundled. Those shares will be bundled in a receipt called as American Depository Receipt, and these receipt will be issued by the bank in through the help of merchant bankers by the bank in America at stock exchange. So these receipts will be issued or listed on the stock exchange, and now normal people from America will start investing or buying this American Depository Receipt, ADR, not GDR, it is ADR. So they will give money here and they will get the ADR. From here the money will flow to the bank, custodian bank, and after deducting all the expenses, this custodian bank will give the money to Indian bank, okay, and then Indian bank will give the money to the company. So this is a normal procedure. Basically what you did is, instead of directly issuing the equity share, and that is not possible because you issued a different instrument which carries equity share, a different instrument, a certificate which carries equity share, and it might happen that one certificate can carry 5 equity share, one certificate can carry 2 equity shares. We have the GDR example of that. So if you are raising money from America through this way, it is called as American Depository Receipt. You are raising a receipt, issuing a receipt in America. So you got the procedure. Investors will buy from the American Stock Exchange all the ADRs, and then that money will be transferred to this company. Simple. So this is ADR, and GDR is very simple. Global Depository Receipt has the same procedure. So this company will give 10 crore shares to the custodian bank, and that custodian bank will issue GDR, a certificate, Global Depository Receipt, and they will list those GDRs on the stock exchange in some other country, not America, other country, and the people from other country will start investing in that. It can be in euro, dollar, pound, anything. If you are raising money through the same procedure outside America, then it is called as Global Depository Receipt. Otherwise it will be called as American Depository Receipt. So what are the benefits of Global Depository Receipt and American Depository Receipt? First of all, the benefit of American Depository Receipt is for these people. American investors, US investors can invest in a foreign country, in Indian country. US investors can invest in Indian company through this way. So that's a benefit. They get diversification, they can get the risk reduced. The another benefit is that Indian company gets the access of foreign market to raise money. Okay. What are the disadvantage? The disadvantage is the exchange rate risk for these investors also. No, not for these investors, this Indian company, because this Indian company will have to pay dividend in terms of foreign currency. So exchange rate will come in between. Disadvantage is it will have political factors, exchange rate risk, and so on. And there will be, this is a disadvantage for an Indian company, that they will have to pay dividend, interest, like things in foreign currency. So the exchange rate risk is there. What is the disadvantage for these people, US investors? Language barrier is a disadvantage for US investors, because US investors, a normal person from US may not be able to understand the balance sheet and profit and loss account and financial statement of this company in order to decide whether I should keep my money invested or I should sell it. Obviously from time to time all the investors has to decide this thing. So deciding about any US company is easy for them, but deciding about Indian company is not easy for them because of the language barriers and lack of standardized method of presenting the financial statements. So that's the advantages and disadvantages for both company and investor. One advantage for company, one disadvantage for company. One advantage for US investor, one disadvantage for US investors. The next thing, GDR. What is the advantage of GDR to the issuing company? First advantage is they get access to the foreign market, same reason. The second advantage is they get rise in the capital. Both the points are same. Okay, I don't know why institute has given this. The next disadvantage is of GDR to the investor. What is the advantage of GDR to the investors? It's simple. It helps in diversification, it reduces the risk, and more transparency. More transparency is not a point. I don't understand again this point. More transparency since competitor securities can be compared. Question number 10 and 11 I left for you, that you can give it a reading and then complete it. Question number 12 we are not going to consider because it is not a separate part. Everything that we discussed in foreign currency convertible bond is applicable for euro convertible bond. See, understand one thing, foreign currency is a broader term. Okay, it's a house, and in that house this is the one member of that house. Euro convertible bond, there can be a pound convertible bond and other currencies also. So both has the same meaning. If you read it, you will realize that what is the difference between both. There is no difference as such. This is narrower term, that is broader term. So with this we finish our revision of international sources of finance. The last topic is left, which is called as discuss the complexities involved in international working capital management. We have completed the two parts and this is going to be the last part, international working capital management. Okay, so what is working capital? Working capital is current assets minus current liabilities. What is current assets? It's all about stock, debtor means receivable, and cash mostly, and current liability is all about creditors. So in order to manage all these things, there are four complexities. When you manage this at an international level, managing the working capital at domestic level is quite easier than managing the same at international level, and 4 points has to be kept in mind. So the first point is short-term loan. Whenever you will have to take the short-term loan, there will be a wider options. You can take the loan. Let's say this is your parent company and these are your subsidiaries in different countries. You can say US, UK, Japan, China. I will now start a subsidiary in China, and let's say Brazil. So you have subsidiaries opened up here. So whenever it will be the time to raise funds, you will have a lot of option. It's not just India for short-term capital loan. It can be US, UK, Japan, Brazil. You will have to take the interest rate. You will have to see the exchange rate. So there will be a lot of calculation and working before making a final decision of how much money to raise and from which country we should raise. So wider option of financing is there. That becomes the first complexity. The second complexity is interest rates and taxes. All the countries will have different interest rate and different tax rates. So we have to consider the tax benefit also, and the interest rates also. We will always prefer lower interest rate and higher tax benefit. Higher tax benefit, not in terms of percentage, but in terms of currency. So that is the second complexity. The third complexity is always same for everything. Foreign exchange risk is there. Foreign currency is involved. It will be transferred from one country to another country. A lot of stocks will be transferred. Raw material will be transferred. It will be shipped from one country to another country. So exchange rate risk will always be there. Second thing, there will be a restriction on transferring the money from one country to another country, one subsidiary to another subsidiary. See, if we have some funds in America, we can transfer these funds to the UK because UK needs it. But there will be restrictions by the US government to transfer the funds to any other country. So we have to deal with that thing also. It's not that easy to transfer the funds in working capital when you are working internationally. So that will be a problem. And the last problem will be political risk. Political risk, you will have to deal with all the political situation because you have limited knowledge. You cannot have in-depth knowledge of all the country's political situation, right? You can have the in-depth knowledge of your own country. Otherwise, I don't think so that everyone will have knowledge of all the country's political situation and political contacts, etc. So the very first thing, financing options, wider financing option. Second thing, interest rates and tax rates are different. Third thing is restrictions on movement of cash and also exchange rate risk. And the last thing is political risk. That was something as a complexity involved in working capital management. Then comes, what are the main objectives of cash management? We are going into working capital and we are first talking about cash. So what are the objectives of managing cash internationally? The very first thing is to minimize the risk, currency exposure risk. That's the main objectives. If I am appointed Let's say for example, if I am appointed to manage the cash of all the subsidiaries, that means I am managing the cash internationally. It's not just my own country in India, own company in India. It is other companies which is situated in other countries as well. I will have to manage the cash of those countries, those companies as well. So in that time, at that time, my first priority will be to minimize the risk. I will obviously go for minimizing the overall cash requirement of all the subsidiary. See, lesser the cash balance or requirement of all the subsidiaries, lesser will be the risk automatically. So without affecting the operation, without disturbing the smooth operation, I would want that the cash requirement will be as minimum as possible. Then comes the transaction cost. I will try to use the netting concept in order to minimize the transactions between subsidiaries, so that I can minimize the transaction cost, I can minimize the exchange rate risk. I will also try to use all my contacts with the government of every country, so that I can minimize the political risk also. I would want to ensure that my company in that country will continue to operate smoothly. There should not be any problem. So that is also my objective. The next objective is to take the benefit. See, if one country is allowing free movement of cash, so that is something, a benefit that is available to you, and you can take that benefit. You can transfer money from that company to any other company who needs funds. So to take the advantage of economies of scale or reap the benefits of superior knowledge, these are some points. Reducing the risk, reducing the balance of cash, reducing the transaction cost, reducing the political risk, and then comes economies of scale, taking the benefit of that. Then comes centralized. How the centralized cash management helps multinational companies. First thing, when you manage the cash centrally, there is one option that every country will keep on every company in every country will manage their cash by themselves. Okay, but in that case, what will happen, that if this country wants loan, they will raise the loan in their own country at whatever rate given. We may lose some money because of that, because this might happen that the same loan was available here at a lesser cost. So if the cash is managed centralized, if the cash management is centralized, then what will happen, all the cash requirements will first come here, and we will analyze what is the best possible way to solve that problem, and then we will solve it, take the benefit. So how this centralization of cash management helps the entire company? The very first thing, it helps to reduce the cash balance as much possible without affecting the business. Then we can also help in the liquidity requirements. If the cash is centralized, we can help in the best possible and lesser cost way to complete the requirement of liquidity. If any company wants fund, liquidity requirements means if any company in any country wants fund, it may be possible that we will raise the funds for this company from that country because the cost is lesser. So that is possible only when the centralization is there. The third thing is we will use various hedging strategies in order to minimize the exchange exposure. You remember netting option. If the cash is there, we have to transfer. Let's say for example, this company has to pay $12 million. Okay. And this company had to pay to this company around $15 million. So understand the chronology. What is happening? Let's take that this company, all of them are subsidiary. This subsidiary had to have around 15 crores of dollars, $15 million of liability. So this party has to pay to this, and this party has to pay around $12 million to third party. Now, if the centralized cash management is not there, this company will bear the exchange risk on $15 million and transaction cost on $15 million. Also, this company will bear the exchange risk on $12 million and transaction cost on $12 million. So in total, it is $27 million that is being transferred from one country to another country. So imagine a transaction cost on $27 million. But if the centralization is there, what we can do is we can ask this company to directly make a payment of, just a second, to directly make a payment of 12 to this and 3 to this. So in total, instead of bearing a transaction cost on 27 million, we will bear it only on $15 million. That's it. So isn't it beneficial for the company? And that is possible only when the centralization is there. Next. Yeah, because of all these hedging strategies and all, it will help the center, means the parent company, to maximize the returns, to take the benefits of multinational netting, the recent example I had given you of netting, then to utilize the transfer pricing mechanism for whatever benefits we can reduce the taxes and everything if we utilize this. And the last 3 points are about to exploit the currency movement correlation. I told you that if there are payables and receivable, then it should be payables and receivable in different currencies, then they should have positive correlation. If there is only payable or there is only receivable, they should have negative correlation. Okay, and this is pooling of fund. Why positive correlation? Because if there is a profit in payables, there will be a loss in receivable, hence the net loss or gain will be zero or at least minimized. In terms of payable, why there should be a negative correlation in currency? Negative correlation means if USD is going up with one currency, it will go down with another currency, and in that case we will be saved from bearing any exchange rate risk. I explained this here if you remember. Yeah, here. See, if you remember this, we had a receivable of 1 lakh and payable of 1 lakh Australian dollar, receivable of 1 lakh euro. So we have receivable and payable both in different currencies. And now this was the rate 1.20 which became 1.30, and then Australian dollar 1.50 which became 1.60. So you can see in both the cases USD is the price currency which is depreciating. Means it has a positive correlation. Positive correlation means in both the cases it is going in the same direction. USD is depreciating here, that means positive correlation. It is appreciating here, that means it is positive correlation. But if it is depreciating here and appreciating here, that means negative correlation. So if we have receivable and payable, means inflow outflow, then it should have a positive correlation. What will happen? Instead of paying $1,20,000, now we are paying we are receiving $1,30,000. So it's a benefit of $10,000. But in terms of payables, instead of paying 1 lakh into 1.50, 150, we are paying 160. So there is a loss of 10,000, but net loss is 10,000 positive, 10,000 negative. It is zero. Why zero? Because of positive correlation. But if only you have payable, let's say we have a payable of $1 lakh euro, same thing, and $1 lakh Australian. And in that case, what happens? There should be negative correlation. If the dollar is appreciating here, it should depreciate in some other currency. So what will happen? See, we had a payable of 1,20,000, but ultimately after 6 months exchange rate changed and we had to pay 1,30,000. So that was a loss of 10,000. Okay. And in that case, we had a payable of 1 lakh Australian dollar. So at the given exchange rate, it was $142,857, but later on we had to pay only 125. So there was a profit of 17,857. Loss of 10, 17 ka profit because of negative correlation. So we have reduced the risk. So this is all about centralized cash management. Then comes investment of excess cash or surplus by MNCs. I left it to you. This is just a part of practical, so you can skip it also if you want. This is not important from exam point of view. The most important topic was stockpiling. Stockpiling. See, what happens is, Delhi 8 million, 12 million. Yeah. What happens is, let's say your parent company is in Delhi, and then your one subsidiary is in Mumbai, and another subsidiary or another your company firm is in London. And both Mumbai firm and London firm does the same business. So they might require the same raw material which is provided by the parent company from Delhi. Now what happens is, when it comes to maintaining the stock, what I want to say is, London company will, the company in London will maintain higher level of stock than the Mumbai company, and there are certain reasons to that. First of all, the reason is lead time. We can transfer the stock whenever required to the Mumbai company in, let's say, 2 days, but it may take 20 days for London company to receive that material. So if I will receive it after 20 days, I will have to keep 20 days stock, at least 20 to 30 days. So my stock will be higher than Mumbai company stock, even though we are producing the same number of unit every day. The production is same, but still London company will keep higher stock. This is called as stockpiling, pile up. This is called as stockpiling. And why it is called as stockpiling? Because of this reason. First reason, lead time is high. Second reason, there can be political risk. There can be some disturbance in transferring stock from India to another country if the relation of these two countries goes worse. So second reason. Third reason is, even though the material is shipped and reached to the London on time, it will take a lot of time to clear the custom formalities. So that's the third bottleneck, which forces the London company to pile up the stock. That's called as stockpiling. So what are the things that we learn here? An international firm keeps larger or a bigger stock than EOQ level. This is called as stockpiling. And there are various reasons for that. The first thing is political disturbance. Importing country's currency. Okay, one more is country's currency depreciates. If the importing country's currency depreciate, they will have to pay more for importing. That's why what they will do is, they will pile up the stock. They will keep the higher stock in the beginning itself. Even though sometimes they will be ready to pay more, but they will not be ready to stop the operation just because the stock is not there. So what happens is, in the beginning itself, even though the stock rate, the exchange rates are not that favorable, still the companies would prefer to buy, just give me a second, to buy the raw material in the beginning in order that the business should continue. So the first thing was political disturbance. The second thing is, importing country's currency will depreciate, then imports will be costlier. The next thing is this probability of interruption in supply. If the probability of interruption in supply is high, let's say this route is not clear, if some problem happens to the ship, so if the probability of interruption to the supply is there, then also it will go for stockpile up. Another reason is lead time is larger. Let's say I told you that instead of 4 days, it takes 20 days to reach to the material in London. So that is one of the reason. Another reason is custom formalities. Okay, so this is all about stockpiling. Considering all these things, we should also consider the cost, because if we pile up the stock, it increases the carrying cost. We need more space, so higher will be the rent in that case. So in order to maintain a balance, we should consider the cost as well as benefit of stockpiling. Okay, the last question was a note on international receivables management. Now, it might happen that we are selling, just a second. Yeah, it might happen that we are selling goods internationally, exporting the goods to company A, let's say to also to company B. But company A is our own company. It is our own company. Okay, it's a subsidiary. So this is called as intra-company transfer. So whatever receivables are there from A, it is intra-firm receivable because that is all our company itself. But if we have transferred or exported or sold goods to company B and we have no relation with that company, it will be called as inter-firm receivable. So there are a couple of things which are given in terms of in case of inter-firm sales and in case of intra-firm sales. I'm leaving this to you. Now we will discuss about some practical questions. That is the most important part. I have taken almost 50 minutes to discuss the theory. Just give me a second. Okay, there are 8 questions in total and we skipped the first one. I will discuss about the 7 questions now. If you remember this question, okay, while starting the revision of practical question, I assume that you have read the question because I'm not going to read the question. I will just give you the brief of the question and I will explain the answer of that. So if you remember this question is all about Indian company going to America and investing there. They wanted to invest around $11 million in America. Okay, the spot rate was 48 rupees per dollar and there were two real or we can say risk-free rate. For US it was 8%, for India it was 12%. So they started a project in America and that was the cash flows in America for the next 5 years. We had to calculate the NPV using foreign currency approach. Okay, I discussed the foreign currency approach means calculating the NPV in foreign currency itself. Don't convert it in home currency. Okay, and we changed the question a little by removing this sentence of required rate of return of this project 14% and adding this sentence that the cost of equity and debt of the ABC Limited, means the company in India, are 15% and 10% and the debt equity ratio is 1:4. Okay, 1:4. So with the help of this data we had to calculate the NPV. How did we do that? Let's start with the answer. I explained in the beginning that there are two different approaches, home currency approach and foreign currency approach. Home currency approach will be learned in question number 3, where what will happen? We will discount the home currency cash flows with home country discount rate. But what happens in the foreign currency cash flows? We will discount the foreign currency cash flows with the foreign country discount rate. Foreign country discount rate. Okay, that is going to happen here. So we cannot use, first of all, 8% and 12% because these are risk free and this project involves risk. So what we did is we calculated the weighted average cost. We calculated the weighted average cost of the company with the given data. So with this given data of 15 and the ratio, we calculated the weighted average cost which came to 14%, but still we cannot use it. Why we cannot use it? Because these are the data of Indian company. That means this is Indian discounting rate. We cannot use Indian discounting rate to discount the foreign cash flows. So what we did is we used the international Fisher effect and we used this 14% as the nominal rate, 12% risk-free rate was given. So we used the difference between these two, not 2%, difference between these two as a risk premium, and it was 1.0179. Then what we did is we assumed the same risk premium will be applicable to the project. Same risk premium will be applicable to the foreign project. So with the help of that we can calculate the foreign project's discount rate, that is called as risk adjusted discount rate. So we took the foreign country's risk-free rate, that is 8%, applied the risk premium, we arrived at 9.93%, and now this became the factor. We discounted all the cash flows with 9.93% because 9.93% is the foreign country discount rate. And then we arrived at NPV. NPV was positive. If you want to calculate or convert in rupees, you can do that. Otherwise, you can leave it at here itself. Since the NPV was positive, we accepted the project. This was all question number 2. Let's discuss about question number 3. Now, let me give you brief about question number 3. Question number 3 is all about a company who is managing a business in India, okay, and it is contemplating to expand into a country which is Africa by acquiring a group of stores having the same line of operation. So basically, from India, I'm going to acquire some already existing companies in Africa, okay, and I will start the investment. There are a couple of things which is given. Inflation in Africa was 40% and in India it was 10%. Okay. Then the cash flows were given in this question, but the major part was, though all these cash flows are in real terms, so not even a single year's inflation is included in this. Okay. But here in the question, it is clearly written, yeah, that the third year nominal cash flow, not the real one. So we will have to convert the real cash flows into nominal. So third year nominal cash flow will continue perpetually, indefinitely. So basically, if you have to calculate the NPV, first you have to calculate the NPV of 0 to 3 years, then calculate the present value of perpetuity, means from 4 year onwards. From 4 year onwards, the present value is called as perpetuity. So 3 years and rest of the years, present value of all of them will be the NPV. Question clearly says that the exchange rate today is African Rand 6 to rupees 1. It is an indirect quote. It's not a direct but indirect quote, because we are in India and Indian currency is a base currency here. So we are now required to calculate the NPV. Couple of things that the question asked us to remember is African Rand cash flows are converted into rupees and then discounted at a risk adjusted discount rate. So they explained the process how we should calculate NPV. They said first convert the African Rand into Indian currency and then calculate. So that is called as home currency approach. In the next sentence, they gave that risk adjusted rate is 20% at which you have to discount. In the last part, they said ignore taxation. We ignored the taxation, and present value factors are given. Whenever the present value factors are given, you remember that you have to use these rates only up to 3 decimals, because institute wants everyone's answer should be same. So how did we start? First of all, we started with calculating the exchange rate of every year, because we have to convert the African Rand into rupees as the question suggested. So we need exchange rates of every year. We use the purchasing power parity theory in order to calculate the exchange rate, but the quotation was given indirect, and we learned that if the indirect quotation is there, inflation of foreign country should be written in the numerator. Inflation of foreign country, inflation of domestic country, and so on. So we put this: foreign countries inflation is 40%, Indian countries inflation, Indian domestic country is India, whose inflation is 10%, F by 6. So this is the first year's forward rate. We will be using it as a spot rate for first year. Then with the help of that spot rate or forward rate, we calculated second year's forward rate. With the help of that, we calculated third year's forward rate, that is 12.37. So in the first working, what we all did is calculated the exchange rate of 1 year, 2 year, 3 year. Okay. Now, present value of cash flows for year 0 to 3, first part. We took the Indian real cash flows and then took inflation index. We multiplied the real cash flows with the inflation index to arrive at the nominal cash flows. Because question says we need to discount nominal cash flows, we will discount it. Always remember, real cash flows should be discounted with real discount rate, and nominal cash flows should be discounted with nominal cash rate, nominal discount rate. So real cash flows converted into nominal cash flows in rupees. We did the same thing with African real cash flows. We took the African inflation 1.40. Then we converted this one also in nominal. Now both the real cash flows have been converted into nominal cash flows, but this is still in African Rand. So we took the exchange rate we calculated in the first working, and we converted this African Rand into Indian rupees. So now African cash flow is also in rupees, Indian cash flow is already in rupees. We can total both the cash flows, then use the present value factor at 20%, then discount it. So we have arrived at negative 59327. That is just the NPV of first 3 years. The question is still not over. The question says that the third year present value, the third year nominal cash flow means 16,637. This is the third year's nominal cash flow of both the countries. This will continue forever. So when they say forever and indefinite, we use the concept of perpetuity. So according to the concept of perpetuity, annual cash flow, that is 16,637 divided by rate of interest, will be the present value. So 83,185 is the present value at the end of year 3. Remember, it is at the end of year 3 because you use the cash flows of year 4. That's it. So convert that third year cash flow of 83,185 into present value. Convert this P3 into P0. How will you do that? P3 into P0. Just discount that 83,185 by 3 years factor. We did that and the answer was 48,164. So we have to answer from 0 to 3. There is negative cash inflow of 59,327 and after third year it is 48,164. Good. Then we calculated the present value, the total of this first 3 years NPV and the rest of the NPV. Ultimate answer was negative, hence the project should not be accepted. Okay, with this we will end question number, this was rough working 3. Okay, let's talk about question number 4. What is it in question number 4? Question number 4 is all about a company in America who wanted to stop exporting to India and set up a subsidiary in India. Till now it was exporting to India, okay, exporting to India, and till now it was exporting around 2 million units every year. But he saw that company, it saw that the competition is rising and other multinational company is opening up, starting a subsidiary in India. So we should also start a subsidiary because that will increase the sales, right? At present they were selling 2 million units, but they are expecting that if we continue to export, our sales will decrease and we will only be able to sell 1.5 million units. It will decrease to 1.5 million and the selling price is $80 per unit and the variable cost is $40 per unit. This is in case of exporting. But if we stop exporting and start a subsidiary, first of all we will have to set up a plant. So in that case there will be some initial investment which will be of $500 million, and then the working capital will also require $50 million in the beginning. Yeah, in terms of export, when we were continuing with the export, already $15 million was invested in working capital. But if we start with the subsidiary, the total working capital requirement is 50 million. Okay. Now there are couple of points given here in the question, and what we did is we divided the entire question into subsidiaries data and export data. So we first divided that this data is related to subsidiary, that the variable cost will be $20 per unit. We will still sell at $80, but variable cost will reduce from 40 to 20 if we start with the subsidiary. There will be some additional cash fixed cost, that is $30 million. Okay. We ignored this $3 million because it was an allocated expense. It is irrelevant for the purpose of decision making. Then production useful life was 5 years and no salvage value. So we can take the depreciation on the entire 500. 500 divided by 5, that is 100. Then the next data was about the existing working capital in export, that is 15 million. This data was for export. The next data was also for export, that we were selling 2 million, but now we will be selling only 1.5 million because of the competition. The last two data is applicable for both, that is the tax rate and the project's discount rate. Now we had to take a decision. How will you take a decision? It's very simple. You calculate what is the net present value of export option, and then you calculate a net present value of subsidiary option. If the net present value of subsidiary option is higher, go with that, otherwise continue with the export. So we started with export option. First of all, working capital was there 15 million. Okay. Then came the operating cash flows. We sold every unit at $80, variable cost $40. We'll be selling 1.5 million units. So this is a contribution and less 35% tax rate. So every year we would generate after tax cash flow of $39 million. That is for 5 years we calculated the present value, and at the end of 5 years what will happen? This working capital will get released. Always remember that working capital is not an expense, it is just put in the business in the beginning as a cash outflow, and when the business is over you take it as a cash inflow. We did that, and the NPV of export option came to $134.10 million. And then we started with the subsidiary option. We thought that if we start a subsidiary, the initial cost will be, we divided all the cash flows in 3 parts: initial cash flow, operating cash flows, and then terminal cash flows. So fixed assets $500 million, then working capital $50 million. Then from 1 to 5 we started operating cash flows. Selling price was 80, variable cost reduced to 20, then contribution was 60. We would be able to sell 5 million units if we start a subsidiary. Then contribution was 300, fixed cost was 30, depreciation was 100 only because there was no salvage value. So we arrived at PBT, then tax, deducted the tax, we arrived at PAT. We converted the PAT into CFAT by adding back the depreciation, that is 210.50, and that is annual cash flow for 5 years. So we took present value annuity factor and converted it into present value. And at the end of 5 years, working capital will be released. All the working capital will get released. We invested 50, if 50 will be released back, and the NPV of this option comes to 237.203. So don't you think NPV of export option is less than NPV of this option? So go with the subsidiary. X Incorporation should accept the proposed project of subsidiary in India as NPV is higher in that option. That's the end of this question. Let's shift to, you can take a break, but let's shift to question number 5. So question number 5 is there in front of you. This question is also about a US company who wants to invest in India with a joint venture, in a joint venture. Okay. So give me a second. Yeah. Question number 4 was a US company coming to India and setting up a business. Question number 5 is also in a similar way, but it is in a joint venture. That means the entire company in India will have 2 owners. First, the Perfect Incorporation from US, and the second one is Edscure Limited from India. But Edscure Limited offered, given this proposal to Perfect Incorporation to us, we are the Perfect Incorporation, so we received a proposal in which we have to make the entire investment in India. That party doesn't have any money, but that party will operate throughout the year. They will operate the business for us. Okay. So we will have to make an investment, and the investment value will be 200 crores in India for machinery and factory. Okay. It will work for 5 years and then it will be sold at 5 crore rupees. And the depreciation is 20% on the net salvage value. So 200 minus 5 crore divided by 5. It will be 195 multiplied by 20% depreciation. Okay. Then the working capital requirement is 50 crores, and thereafter 5 crores each year will be additional working capital. Okay. The term is that we are ready to invest 200 crores and we are ready to put 50 crores as a working capital and the whatever is required after that also. But what we are going to get in terms of revenue is 55% of the total sales and a royalty on every bottle of that vaccine, that medicine sold, $0.01 per bottle. That's the total revenue to us. Okay. Next comes the second paragraph. They said that Government of India guidelines is that every bottle will be sold at 7 rupees 50 paisa. So for the time being, you are a US company who wants to invest in India. So US is your home country, India is your foreign country, and this is rupees per dollar. Exchange rate is given after that. Every bottle will be sold at 7.50 rupees, and in total 24 crores bottle will be sold in a year. Good. But this 7.5 rupees is going to increase every year by rupees 1. And along with that there will be inflation, the price in addition to inflation. Yeah. Along with that there will be inflation. So that 7.50 rupees will increase by 1 rupees every year, and on that net amount there will be an inflation. So we will have to calculate inflation adjusted selling price multiplied by 24 crores will be the total sales. Now production cost is 40% of the revenue. Okay. we will also bear. If we are bearing the sale price, we are receiving 55% of the sales, we will bear the 55% of the production cost as well. The applicable tax rate in India is 30% and in US is, in India is 30% and US is 35%. And there is double tax avoidance agreement between both the countries. That means whatever tax has been paid in India, we will get the credit of the same in America while paying the tax in America. Okay. In both the countries, taxes shall be paid in the following year. That means if the tax is due this year, tax is calculated this year, for the earnings of this year, the tax will be paid on the next year. For the earnings of next year, the tax will be paid in third year. Then third year's earning, the tax will be payable in fourth year, and so on. The spot rate is dollar. The spot rate of dollar is 57 rupees, and this is indirect quote for us because dollar is our home currency. The inflation in India is 6%, which is also expected to decrease by 0.50% every year, and 5% in US. There is no decrease in the inflation in US. There is a decrease in the inflation in India only. Next, as per the Government of India policy, only 50% of the share can be remitted in the year in which they are earned. You remember we discussed this point in the first part, complexity, that there are some restrictions by the government that you cannot invest all the amount in the first year itself. But the Government of India is allowing us to remit the balance 50% in the following year. So 50% in the same year and the remaining in the following year. Okay. Though the WACC of perfect incorporation is 13%, but due to the risky nature of the project, it expects to earn a return of 15%. You remember this? We cannot apply the home country discount rate because the risk of this project is higher than our company. So the discounting rate should also be higher. Okay, so we'll discount with 15%. Determine whether perfect incorporation should invest in the project or not from the subsidiary point of view. This was the entire question. And how did we solve? We made workings. First of all, we made the workings for exchange rate using PPP theory. Okay. For PPP theory, this is the formula: 1 plus inflation of the domestic divided by inflation of the foreign country is equal to F divided by S. F is the forward rate, S is the spot rate. But this is applicable when it is a direct quote. But when it is a indirect quote, inflation of foreign country means India will come in the numerator. So we started calculating and we did this calculation. For the first year, F is equal to 1.06 inflation of India divided by 0.5 inflation of US multiplied by the spot rate 57. So we reached at 57.54. Then we used 57.54, again added 1 year's inflation. So we got 1 year ahead, we can say, exchange rate. Then we used 57.81, this figure, and added 1 more years inflation. We got this. Then we did the same thing here, and you can see here in the numerator it was 6%, 5.5%, 5%. Every year the inflation of India is decreasing by 0.5%, and we calculated the inflation foreign exchange rate for 6 years. So these are going to be used in the coming time. Now comes the second working: share in the revenue. 55% share in the revenue. You remember? So what was the selling price? 7.5 in the first year. Then it will increase by 1 rupees every year. We did that, and it is sold in India. So India's inflation rate 6, 5.55, 4.54%. We added inflation in every rate. 7.5 plus 6% is equal to this. 8.5 plus 5.5% is equal to this. So this is called as inflation adjusted discount rate. Inflation adjusted selling price. Now this inflation adjusted selling price multiplied by 24 will become total revenue of the company. Now this 190.80 is shared by the joint venture. Means 45% of this will be the share of HQR Limited in India, and 55% will be our share, that is 104. So this final line indicates what is our share in the terms of revenue. Now the next working we did is for the royalty payment. You remember 24 crores units will be sold every year, and on every bottle we will get $0.01. Okay. Now the total royalty becomes 0.24 and the exchange rate is 57 point, exchange rate is this, because this 0.24 is in dollars right now. So we converted the dollars into rupees. This is the total royalty in terms of crores. This is total royalty in terms of crores that we will get. So there are two types of income for us. One is the share of 55%, the second one is the royalty payment. Now take these two figures only. In the first row, I took the 55% revenue share, then I took royalty. Now you remember production cost was 40%. So production cost of revenue only will be taken, because production cost has no relevance with the royalty. That's why this is ignored. So production cost of 40% of this 104.94 is taken here. Then comes the depreciation. Depreciation is calculated simply 200 minus the cost minus salvage value multiplied by 20%. So that came to 39. Okay, all the expenses are deducted. Now comes the profit before tax, and then comes the tax at 30%. Profit after tax is not required right now. What are the all cash flows from this table? Revenue is the cash flow, royalty is a cash flow, production cost is a cash flow, depreciation is only expense but not a cash flow, tax is also a cash outflow. So next working represents cash flows. Again we took the same thing, revenue, royalty, production cost. We just picked it up from the previous working. Then we took the tax payment and we shifted the tax payment in the following year, because question says you don't have to pay the first year's tax in first year itself, you have to pay it in second year. So this is how we paid the tax. For the fifth year we had to increase the column to 6. We paid the tax in the sixth year. Now initial investment is this 200 crores, working capital is 50 in the beginning in terms of rupees, and then we added the working capital every year. See, working capital is not an expense, it is a deposit. So total working capital at the end of 1 year in balance sheet will be 55, here 60, 65, 70. So total working capital lying, because from 0 point to 4 years we have invested 70 crores in working capital, and at the end of 5th year all the working capital will get released. It will be 70 crore positive figure. Released means inflow. Now scrap value, this entire machine or investment of 200 crores will be sold for 5 crores. So we took the 5 crore scrap value in the 5th year. And then this is called as free cash flow in terms of rupees in crores. Total of all these. This is inflow, inflow, outflow, outflow. Okay. Then we calculated how much we can remit to America, our home country, from India to America. So have a look. Free cash flows. We took the same free cash flows and they said that whatever you have earned in any year, you can transfer 50% of that only in that year. So 71.77 is the first cash flow that we can transfer, but 50% of that will only be transferred in the same year and balance 50% in the next year. 35.88 plus 35.89 will be 71.77. Similarly, 50% of 68.71 is this 34.35. So 34.35, 34.36, it will become 78.71. So this is how we did all the calculation, and for the 5th year 82.44 and 82.45. Remember, in the 6th year there is a cash outflow, so there will not be any kind of transfer of 6th year in this or that. You cannot say that, sir, you did 50% of positive figures, so you should do it for the negative figures as well. This is applying maths and not brain. So you have to apply the brain also here. This is CA final. The total remittance comes to this 35.88, 35.88, 34.35 plus this is this year's earnings remittance, previous year's remittance, this year's remittance, previous year's remittance. So this is the total remittance that will be transferred to America, but this is still in terms of rupees. We need to convert it in terms of dollars. So we took there last working. We took this figure 35.88, 35.88, 70.24, 70.24. We took this figure, total remittance from 0 to 6. Then what we did is we used the exchange rate to convert the rupees into dollars. Okay, so remittance in terms of crores, dollars in crores is this figure 71.39 divided by 57.81. It will be this. Okay. Now once you are remitting any amount to the US, you will have to pay tax on that. Now please understand one thing. Here the answer may differ or the opinion may differ. Right now in this question what we have taken is what institute has done. The tax in US will be payable on repatriation amount, not the earnings. Earnings is a different item, repatriation is a different item. So Indian tax is was applicable on earnings. US tax is applicable on the repatriated amount. That is what we have taken and the institute has done. In the previous class, previous lectures, in Hindi lectures, I had taken it on earnings. I will update the same. That is also right from one point of view. But okay, let's follow the institute only from now onwards. Whatever differences are there, I will explain that in the class like I did just now. So what we did is we calculated the tax payable in America. How much? 35%. So first year's cash flow is 0.6236. 35% of 0.6236 is this. And why I have taken it in the second year? Because tax in America also is payable in the second year. In the second year. So second year, third year and so on. Tax, 6th year's cash flow is this in America, American dollars. Tax of that will be payable here in the 7th year. Institute has ignored this tax 0.3840. I don't know why. And there is no valid reason for that. So that's why I have taken it. So this was US tax, this row, you can see this is US tax payable, but question clearly says that we will get the benefit of tax paid in India. How much is the tax paid in India in terms of rupees crores? 11.20. So what we did is we converted the Indian tax from rupees to dollars. So this column, this row shows the Indian tax paid in terms of dollars. So we paid this tax, but payable is this much in US. We paid this much in India. So the balance will only be payable in US. 0.2183 minus 0.1937. So that is the balance payable in US. Now let's take the net cash flow. Net cash flow is simple. This row, remittance in dollar minus the net tax payable in US. So this will become the cash flow. Then you take 15% as the rate because question says this project is risky, so higher discounting rate should be there. We took the present value factor with 15% and then we calculated the present value. This is NPV, which is negative, and hence the project should not be accepted. Now if you follow the US tax also on earnings, then the project's NPV will come to positive. Yeah, but it's okay, follow this only from now onwards. Then we learned about the concept of geared and ungeared beta for the next question, question number 6. This was all question number 5. Question number 6, I told you that what is the derivation of geared beta is equal to this formula. Geared beta is equal to unlevered beta in bracket 1 plus debt equity 1 minus T. And it was simple. First of all, I told you that this company is having equity with 5 crores funds, and this company is having equity plus debt 3 plus 2 crore 5 crores of funds. So this company has debt, this company doesn't have the debt. So this company will be riskier than this company because it has debt. It is more risky because at the time of liquidation, equity holders will get nothing. So this is called as unlevered firm. This is called as levered firm. This is called as ungeared firm. This is called as geared firm. The firm which is financed also through debt is called as geared or levered. Okay. Then we derived this formula. I will not discuss the derivation. You remember this formula. Now beta of the geared company is equal to ungeared 1 plus debt equity ratio 1 minus tax. We started with question number 6 after that. Let's discuss that. What is question number 6? Question number 6 is all about a company in India which is It's Entertainment Limited. Yeah, It's Entertainment Limited. They have an amusement park in India and they want to start the same amusement park because a tourist place in Nepal. Okay, so everything regarding that project of starting an amusement park in Nepal is given to you. The initial investment, okay, let's start with the figures. 20 lakhs was spent for the research. This becomes irrelevant figure for us because this is called as sunk cost. This is not at all relevant. This will be sunk cost. so we will not take it anywhere. The construction cost is 450 crores, out of which half is payable now at 0 point and the other half will be payable after 1 year. I will show you. See, 450, 225 payable at 0 point, 225 payable at 1 year. Okay, then comes the working capital requirement, which is 65 crores from the year end one. Look at that, from the year end one the working capital requirement will be 65 crores. Okay, the after tax realizable value when you will sell the machine or the entire investment, not machine, the entire investment of 450 crores, you can sell it after 4 years at 250 crore, and that is after tax. All the capital gain has been paid out of this. You can sell it at 250 crores. Under the foreign capital policy of this company, they allow to claim the depreciation of 20%. But there is a limit on which you can claim the depreciation, which is 200 crore. So your capital can be maximum 200 crore on which you can claim the depreciation of 20%. That's it. No more than that. So no matter how much you have invested, 450 crore, but the depreciation will be calculated only on 200 crore maximum. That is also on the reducing balance method. We can take the loan debt at 9% from Nepal if we want. The water park will have a maximum capacity of 20,000 visitors per day, but we will be only able to achieve 70%. So 14,000 tickets will be sold every day. Tickets price will be 220 rupees per person. We will also sell food and beverage and fancy gift item. Food and beverage will be sold at 150 Nepali rupees and 50 Nepali rupees. Then on food and beverage and fancy gifts, the profit margin will be there because there will also be a cost. Now, the previous figure that I told you was only selling price. So profit on food and beverage was 20% and fancy gift is 50%. So we'll directly take the profit in the question answer. Now the park would open for 360 days. Every day 14,000 customers multiplied by 360. Total number of customer multiplied by the ticket price, multiplied by the profit on sale of food and beverage, multiplied by the profit on sale of fancy gifts. Okay, now this is important. The staff cost will be 65 crore rupees every year. Insurance cost will be 5 crore rupees every year. The running and maintenance cost will be 25 crore rupees in the first year, and then it will increase by 4 crores every year. And then the company would apportion existing overheads to the tune of 5 crores to the park. This is irrelevant for the purpose of decision making, so not at all required. Then all the costs and receipts given in the entire question except 3 figures. The construction cost 450 crores, realizable value 250 crores, and your running and maintenance cost, which is given here 25 plus 4. Except these 3, all the costs and receipts are expected to increase by 5% per year. The current spot rate of Nepali rupees is 1.60 per rupee, not at all required in this question. Tax rate in India 30%, Nepal 20%. Okay. Then the current WACC of the company is 12%. Average market return RM is 11%, RF is 8%. Whenever RM and RF is given, you understand that we have to use the capital asset pricing model. The beta of the company is given in India. The company's funding ratio of this water park will be 55% of the equity and 45% of the debt. Okay, so this is going to be the ratio. Now, being a tourist place, the amusement industry in Nepal is quite different from the Indian counterpart. So Indian data cannot be used for the Nepali project. Indian data cannot be used for the Nepal's project. So that's why what we did is we did some research and found that there is one competitor in Nepal who is close to what we are doing. His business is close to what we are doing, and we can use that competitor's data if required. The company has gathered the relevant information of the competitor and who has a market equity value of 1850 crore and the debt of 510 crores. So debt equity ratio can be calculated of the competitor, and this is the competitor's equity beta, which is 1.35. Okay, state whether its entertainment should undertake this project or not. A lot of data is given here. Okay, I will start with this. ₹220 rupees was the ticket price, right? 220. Yeah. So see, first of all, half of the production will happen here and the half will happen here. So first year of operation will start from second year. 225 crore invested here, 225 crore invested here. That means the first year of operation will be this 2345. Okay, the selling price is 220 rupees today, and it is going to increase by 5% every year. So from this to this year, increase by 5%, 220 plus 5%, plus 5% will become 242.55. Add 5% in that, it will become 254.68. Add 5% in that, it will become 267.41, and so on. Got it? Then in the similar way, profit on food and beverage. See, 150 rupees was the selling price, multiplied by 20% is the margin, that is the profit, multiplied by 1.05. We shifted it to 2 years, so it becomes 33.07. Add 1.05, you will keep on getting the figures. Similarly for fancy gifts, selling price was 50, profit ratio was 50%, 1.05. So this is your total revenue per visitor. Now how much is the total visitor per annum? 20,000 is the capacity, 70% can visit every day, so 14,000 into 360, that's the total visitor, divided by 1 crore, that's the total visitors in crores, 0.504. So this is not rupees in crore, this is also in crores. Okay, so per visitor revenue is 303.18. and total visitors are 0.504 crores every year. So every year's revenue will be this. Then this is just the revenue part. Let's discuss the costing. Staff cost will be 65, which will increase by 5% every year, since the operation is starting in 2 years, at the end of 2 years. So for the first year 1.05 increase, then also 1.05 increase will be there. Staff cost, insurance cost will also increase by 1.05 and 1.05. Then running and maintenance cost is already increasing, 25 plus 4 plus 4 plus 4 plus 4. In the question it is clearly given that all the costs except those three will increase. So don't apply your logic, because staff cost will start up staff cost will start from this point when the operation will start. So you may ask that 65 should be taken in the first year of operation. No, question clearly says every cash flow will increase by 5%. So maybe staff cost of 65 is given in today's terms. In actual the expense was 71.66. Okay, running and maintenance, and then comes the depreciation. Depreciation is applicable only on the maximum capital limit of 200 crores. So 200 into 20%, 40. Then 200 minus 40 will be the balance, which is 160 into 20%, 32. So instead of doing this, what you can do is, at the time of reducing balance method, deduct 20% from the depreciation directly. 40 minus 20%, 32. 32 minus 20%, 25.60. Your figure will be exactly correct. Okay, this is total expense total of all those 4 figures. Then comes profit before tax, revenue minus expense. Then comes profit after tax. We don't need tax, so directly profit after tax, which is 30% less PBT. Okay, PBT less 30%, that's this figure. But can we discount profit after tax? No, we are not supposed to discount the profit. We are supposed to discount the cash flows. So convert this profit into cash flows. We will add back the depreciation because it's a non-cash item. Then initial investment of 225, 0 and 1 time, 1 year time. Working capital starts at the end of 1 year, it clearly says, and then it gets increased by 5% every year, 5% every year. So these are the calculations. See, 65 plus 5% becomes 68.25. So the balance at the end of year 2 should be 68.25, but we already had 65 from the previous year. So how much extra is required to be invested? 3.25. That's what we did. Then this. Instead of doing this calculation, if you will add 3.25, add 5% in 3.25, it will be the same figure. Add 5% in this, it will be the same figure. So instead of doing long calculation, you can go with the short calculation if you understand the logic. And then after tax realizable value of 250 crore is taken at the end. Then we calculated the net cash flows. Net cash flows is nothing but, see, profit after tax plus depreciation less initial investments, working capital deducted, and then after tax realizable value added. So this is the net cash flow after tax. Now this cash flows has to be discounted, and we took the discount rate of present value factor at 10.66%. Now from where did this 10.66% came? See, for that purpose we wanted a discount rate. Okay, so we calculated a discount rate in the fourth working, the working just before NPV. And how did we calculate the discount rate? Since this project includes equity as well as debt, we took weighted average cost of capital. We took cost of equity multiplied by its weight 55%, cost of debt multiplied by its weight 45%. But debt on debt we have a tax saving. So 9 minus 20%, tax saving on interest, 9 minus 20%. 20%, why 20%? Because we are paying the tax in Nepal. We are doing the evaluation in Nepal. So 9 minus 20%. KD 1 minus tax should be taken. So this is working cap, weighted average cost of capital. This rate was used for the purpose of discounting. 55 was given in question, 9 was given in question, 20% tax rate was given in question, 45% was also given in question. What's not given in question was 13.49, the cost of equity. So we calculated this cost of equity here using capital asset pricing model. We can calculate risk-free rate 8, beta 1.83, market rate 11 and 8. Market rate was given in question, risk-free rate was also given in question. What was not given in question is the beta of equity. So we calculated the beta of equity using geared and ungeared method. Beta of equity. For the purpose of beta of equity, we wanted beta of asset. So we calculated beta of asset from this side. And for the purpose of beta of asset, we used beta of the competitor company's equity. Now understand the logic here. Since that company, the competitor, was close or a proxy company of our project, we could have used this beta directly in capital asset pricing model 1.35. We can use that 1.35 directly here, but we did not. And what is the reason behind this? The only reason behind this is, although everything of the competitor and our project is same, the only difference was debt equity ratio. In their company, competitor, the debt was 510 and equity was 1850. So that is somewhat (21.61%) debt, and in our company it is 45% debt. Understanding? So the risk of debt is different in this equity beta. That's why what we did is we first removed the risk of debt from the equity beta of competitor. By using this formula, we arrived at beta of asset. Beta of asset means there is no debt. So we applied the same beta of asset in our company, 1.1061, and then used our debt equity ratio. So we removed the debt risk from competitors beta and added the debt risk of our company in the beta, and we arrived at 1.83. This 1.83 is used here to calculate cost of equity. This cost of equity is used here to calculate the weighted average cost of capital, and this weighted average cost of capital is used as a discounting factor here, 10.66%. Then present value then NPV is negative, hence do not accept the project. Over and out. This was question number 6. Let's talk about question number 7. Now question number 7 is an Indian IT company who wants to set up a business in China. Where? China. In the previous part, an Indian company wanted to set up a business in Nepal, right? And that is Indian company going out. And in question number 5, it was US company coming to India. In the question number 4, also US company coming to India. In question number 3, Indian company going to Africa. Indian company going to Africa, Indian company going to Nepal. Now Indian company wants to go to China. So they want to set up a subsidiary in China, whose project life will be 2 years. Okay. And the inflation in China is 8%. Clear? Operating cash flows will be received. The initial investment will be 30 lakhs in the purchase of land. and the same land will be sold after 2 years at 35 lakhs. So 5 lakhs is the capital gain. Also, there will be investment in the beginning in office complex of 15 lakhs Chinese yuan, which will be sold after 2 years to a which will be sold after 2 years at 5 lakhs Chinese yuan. But the depreciation will be provided in such a way that in books the salvage value will be 0, and a 0 salvage value when sold at 5 lakh, the entire 5 lakh becomes capital gain. So by selling land or by selling office complex, you are earning 5 lakhs Chinese yuan Chinese yuan as capital gain. Okay, now the company is planning to raise the required funds through GDR. They are not raising from India nor from China. They are going to raise the funds through Global Depository Receipt in Mauritius. Now each GDR will have 5 common equity shares of the company as underlying security, whose current trading price is 200 rupees. In India, 200 rupees per share is sold. Face value is 10. The company has currently paid means D0, the dividend of 25%, which is expected to grow at 10% per annum. Okay, so D0 growth rate, the total issue cost estimated to be 1% of the issue size. Now this 25% will be assumed as the dividend rate. Okay, dividend rate, which will be applicable on face value. Rate is always applicable on face value. Face value is 10 into 25 is 2.5 rupees D0. Add a growth of 10% in that. All this data will be used to calculate cost of equity so that we can use that for discounting purpose. Now annual sales are expected to be 10,000 units at 500 rupees, 500 Chinese yuan. The price of the unit is expected to rise at a rate of inflation. It will not be stable at 500. It will increase by the rate of inflation 8%. So 500 plus 8% for the first year, 500 plus 8% for the second year. Variable operating cost is 40% of the sales. Fixed operating cost is Chinese yuan 22 lakhs per year, and it is going to rise by the rate of inflation. Tax rate applicable in China is 25% for capital gain as well as income. Government of India policy: no further tax shall be payable in India. The current spot rate is 9.5 rupees per Chinese yuan. Nominal rates are given 12% in India and 10% in China. International parity holds true. Now, first part of that question asks that identify expected future cash flows in China and determine the NPV in Chinese yuan. That means this is a foreign currency approach. Then determine whether Opus Technologies should accept the project or not if there is no restriction on transfer of funds from China to India. That means this is home currency approach. So we first calculated NPV using foreign currency approach, then we calculated the NPV using home currency approach as well. Have a look. First of all, we calculated the cost of equity. Calculate cost of equity. So this is calculate cost of equity. How did we calculate? Dividend growth model. So net issue price, that is market price into 1 minus flotation cost. In security valuation chapter, you might not have learned about this 1 minus flotation cost, but in inter cost of capital it was there. So if there is any flotation cost, it has to be deducted from market price. Why? Because we want the funds that we are able to use, not the funds raised by the investor, from the investor. This is the amount paid by the investor, but this is the cost paid to the service parties or intermediaries, is equal to D0 1 plus growth divided by cost of equity minus growth. We shifted this equation to this. It become cost of equity is equal to D0 1 plus growth divided by market price in bracket 1 minus flotation cost plus growth. So 10 into 25%, this is 2.5 D0 into growth divided by 200 minus 1% flotation cost. The cost of equity comes to 11.39%. This will be used. Now, first of all, we calculated the after tax proceeds of land. We purchased the land at 30 lakhs Chinese yuan. We sold it at 35 lakhs. So capital gain is 5 lakhs. So we will pay tax at 25%, which is 1,25,000. So we received 35 lakhs, but the tax will be 1,25,000 payable. Balance amount left with us is 3375. 35 minus 125. Okay. Then we did the same with the office complex. We purchased office complex at 15 lakhs. At the end, we depreciated the entire 15 lakhs from the books. So in the books it is showing at zero value, but we sold the same for 5 lakhs. So the entire 5 lakh will become capital gain. We will pay tax of 125 on that. We received 5, we paid 125, balance will be received by us 375. Okay, let's go to the calculation of NPV. How many units we are able to sell every year? 0, 1, 2, 10,000, 10,000. Selling price is 500 at today's price. Add inflation of 8%, it will become 540, and again add inflation of 8%, it will become 583.20. Okay, then this is total sales. When you multiply the units with the selling price, then variable cost, then fixed cost will also increase by 8%. Okay, in variable cost the inflation is already included. Depreciation is 7,50,000, 7,50,000, so that 15 lakhs entire value of the asset will get depreciated. Profit before tax and profit after tax is 75%, because tax rate is 25% in China. Then comes depreciation. Why we are adding back the depreciation? To convert the cash flows into to convert the profit into cash flows. So in profit after tax, add depreciation, add the sale proceeds of the land, add the sale proceeds of the office, and then initial investment 45 lakhs. Net cash flow is 45 lakhs, 8355, and that we use this discounting rate of China, and then we calculated the NPV, it came to negative. So we will not accept the project if this is the case. But if we think about transferring the money from China to India and then discounting at Indian rate, so how much amount we are going to transfer from China to India? That 45 lakhs will be converted in Indian rupees, though invested in China only. 835 converted in Indian rupees, and 46 lakhs will be converted. So these three figures will be converted. For that purpose we need exchange rate, and that's why we will use interest rate parity theory. So for first year, nominal rate of India and China 9.67 is the forward rate. Then nominal rate of India and China, then this is the rate 9.85. So these two are the exchange rates for first year and second year. So what we did is we took the net cash flow, 45 lakhs, 8,35,000 and 46 lakh 37,000. Then we, with the help of exchange rate, we converted them into rupees. Then we used the rupee discount rate. Have a look. 12% is the nominal rate of India. We use the rupee discount rate to discount these cash flows, and then NPV is positive. We will accept the project. That's what the entire answer is. Okay, last question is left. Have a look. In this question also we wanted to expand the operations and planning to install a manufacturing plant in US. First we went to Africa, then we went to Nepal, then China, and now we are going to US. US came to us, to our country twice or thrice. We should go there. But we are not raising the funds in America. We are raising the funds through global depository receipt, and every depository receipt will have 2 shares. So how much total amount is required to be funded, raised? We need $10 million to invest in the project. So do you think I should raise $10 million from the market? No, you should raise more amount, because some of that amount will be taken by the intermediaries as they are providing the service. So 10 million is the net of any kind of issue or expenses or flotation cost. And how much is the issue, expense or flotation cost? 2%. So this 10 million is after deducting 2%. That means it is 98%. So we will calculate 10 million divided by 98% will be equal to 100%. How much we should raise from the market. The project will financed through the issue of GDR, and the details of GDR is given to you here. That expected market price of each share will be 250 rupees, face value 100, and 2 shares will underlie 1 GDR and shall be priced at a 10% discount to the market price. Expected exchange rate 60, and dividend rate was dividend to be paid was 20% with a growth rate of 12. What did they ask? They asked us to compute the number of GDRs to be issued in the market. So think from the angle of the market. How many number of GDRs you will have to issue. It depends upon how much funds we are raising divided by what is the issue price of 1 GDR. So how many funds we are raising? 10 million divided by 98%. So funds to be raised, first working, 10 million divided by 98%, that's 10.2041 million. Then what is the issue price of GDR? See, 250 rupees for one share. There are 2 shares in each GDR, that's why multiplied by 2. And then issue price will be at 10% discount. That means only 90% will be taken. So this is the issue price in rupees divided by 60 means exchange rate. So this is the issue price in dollars, 7.5. We are raising $10.2041 million at $7.4 per GDR. So the total number of GDR that will be issued is 1.306055 millions. That's around 13,60,550 million. Sorry, zero. Then dividend in each GDR. How much dividend we are paying for every GDR? See, 100 is the face value, 20% is the dividend rate. So 2 rupees multiplied by every GDR covers 2 shares. So this is dividend of 1 share multiplied by 2 will be the dividend of 2 shares. The total dividend will be 40. This is expected, so don't add growth. Already the growth is added in that. Now, what is the formula of the cost of GDR? It is as good as cost of equity. Same formula. Take the amount that you are paying, that is D1 in the numerator, divided by the amount that you are using, market price net of flotation cost. So D1 is how much? 40 in terms of rupees. And what is the market price? 1 minus flotation cost. This is called as net issue price plus growth. So see, what is the net issue price? The issue price was $7.5 per GDR. It will be 2% will be deducted for issue expenses, so we will take 98% and multiplied by 60 to convert it into rupees, that is 441. The other way to that is 250 rupees per share multiplied by 2, 450 rupees multiplied by 90% because you are issuing it at discount, and then again less deduct 2%, that means multiplied by 98% because flotation cost will be there. It will also become 441. That means what? It means you are paying 40 rupees as an income to those or dividend to those, which is a cost for us. 40 rupees is the cost for us, and how much amount we are getting to use? 441 rupees. So this is the amount which we are using and the amount that we are paying, the cost that we are paying, and plus 12% growth every year, it will become 21.07%. So cost of GDR is 21.07. Raising funds through GDR is costing us 21.07%. That means if we are using 100 rupees from this method, we are paying 21 rupees as a cost, as an interest. So this is cost of GDR, and this is the number of GDRs issued. This was all about the 8 questions. With this, we have ended this chapter. In the next lecture, we are going to start with the corporate valuation chapter. Bye bye for now.